So let me show you the other side of this because, folks, of course, we don't ever just do math one way. So this question is basically the opposite. Now we're changing it. We're saying, well, based on a given pity payment and your financial situation, how much money would you need to make? You see how the question is different? Not how much can you qualify for, it's how much would you need to make. So I'm going to walk through the first one with you just like I did, but this is the one that students really hate. Fair warning. Even those of you who are probably okay with this last one, this is going to throw you off for a second. Maybe not. It just depends. I've seen it happen both ways. So a buyer wants to borrow $150,000. Her recurring expenses are $300 a month for her car and $200 a month for credit card debt. The lender tells her pity will be $1,000 a month. What is the, well, first and foremost, let's read the question. This one wants to know the annual minimum income. So when we find the monthly, we got to multiply by 12. But it's asking how much money they have to make. So what you're basically stating is, okay, if the pity payment's $1,000 per month, we don't care what they're borrowing. So what we're stating is how much would they have to make that $1,000 is only 28% of it. So you're reverse engineering this. It's $1,000 divided by 28%. How much do you have to make to qualify under the 28% rule? Does that make sense for everybody? So it would be 1,000 divided by 28%, because once again, how much would you have to make that 1,000 is only 28% of it? Under the 28% rule, you would have to make 3,571.43 a month. But then you've got the $1,000 a month pity payment plus your $200 a month in credit card. And it looks like, what is that, 300? Plus $300 a month for other recurring debts, which means you need to be able to make enough to qualify for $1,500 in recurring obligations. So in other words, how much would you have to make that this is only 36% of it? So you would divide by 36% now that you've included all the recurring obligations. So 1,500, stupid calculator. It's user error, but I'm going to blame the calculator. 1,500 divided by 36% would be 4,166.67. Now here's the kicker, folks. This is the problem that most people are having. This one is the opposite. The more restrictive one is the bigger number. Because if you don't make this much, you don't qualify for this house. When we're talking about how much you have to make, the bigger number is the more restrictive. Because making anything less than 4,166.67 means you cannot buy this house. So the minimum that you have to make each month is this number. And then, of course, it wants your annual. So you would multiply this number by 12, $50,000. That's what trips people up. Their brains have a hard time grasping that the bigger number is now the more restrictive. Think of it this way, folks. Put yourself in this position. Which would suck more? And pick that one, right? So in this scenario, we're saying, well, if you don't make at least 4,167, you can't buy your dream house. That sucks more than only having to make $3,500 a month. And then in the one where we're saying how much house can you afford, we're telling you that you can't afford your dream house versus you can. That one sucks more, right? The lower payment is what sucks more in the other one. So that's kind of the way to think about it. It's the more restrictive. Which one is restricting you more? Having to make more is more restrictive. And then, of course, only being able to afford less is more restrictive. Tricky, I know. Told you weren't going to love it. Let me give you one to tackle, and then I'll move away from math for the rest of the night, I promise, because the night's almost over, so it's really not that hard to do. But take a look at this one and do it the exact same way that I just tried it with you. Now, let me help you out with something, folks. You do it the exact same way I just showed you, but this one includes HOA dues of $50 a month. That is a housing expense. So that needs to be added into the pity payment before you divide by 28, and it needs to be added into total recurring obligations before you divide by 36. So keep that in mind. HOA dues are monthly housing expense, so you need to add that into the pity. So give it a shot. See what you come up with. Anthony, you're assuming everybody else is right. You could all just be completely and utterly wrong. Oh, okay. All right. As long as you know. All right. I mean, I have the utmost faith in you all. I'm just saying, right? Like, don't count the chickens before the eggs hatch, as they say. Give me just another second here, and I will do it with you, folks. All right, folks. Let's talk about it, okay? Hopefully y'all are feeling comfortable. Borrower wants to obtain a conventional loan for $156,000 with a pity of $1,300 per month. The buyer's HOA dues will be $50 per month. The buyer's car payment is $285, and other recurring monthly debts are $300. What is the minimum monthly income required to qualify? Yet again, this is irrelevant information. We don't need that. We don't care. We're dealing with pity payments monthly. We don't need it. So $1,300 a month in pity plus your $50 a month in HOA dues give us $1,350 in housing expenses. And so what your answering is, Bree says, can you assume that you will always refer to 36 number when you are... No. You cannot assume that in any way, shape, or form. Because if your recurring debts are only $50 a month, then it's going to always be the 28%. So you can never... That's why you have to do the math on both. You can never assume that just because there's recurring obligations that it's a 36. Got to do both. So $1,350 is your housing expense. And so the question you're answering is, what do you have to make each month that this is only 28% of it under the 28% rule? So divided by 28%. And so under the 28% rule, you would have to make $1,350 divided by 28%, which would be $4,821.43. And then you would take your $1,350 in housing expense, because you got to include the HOA dues again, plus your $300 plus your $285 for total recurring obligations of $1,350 plus $300 plus $285. $1,935 is your total recurring obligations. So yet again, the question you're answering, how much would you have to make each month that is only 36% of it? Or in other words, divided by 36%. So when you divide by 36%, you would have to make $5,375 a month. And in this instance, that is the more restrictive because it is the larger number. You cannot buy this house unless you make at least that amount of money. But you always have to do both ratios. And let me show you why, folks. Imagine that the question changed, just to prove the point here, and you only had recurring debts of $50. So now you add in your recurring debt of $50, and you're looking at $1,400 a month in monthly obligations, divided by 36% yet again. The answer changes on you, because now it's 1,400 divided by 36. Now the 28% rule would be the more restrictive. You see, you cannot just assume if there's any recurring debts that it's going to be the 36% rule. It doesn't work. You have to do both every time. Is everybody with me? They are checks and balances for each other. That's it. Now, I will tell you that the math can potentially get much harder. I'm not going to do that to you tonight. Okay, I'm not. But I will tell you that this segues into the hardest math concept in the entire class, in my opinion. And so that's where you take this style of question and you incorporate those amortization factors that I taught you yesterday. And so it'd be something like this. So now you're using the, and this isn't exactly the style of question, but basically what you'd end up doing is you'd be looking at the debt to income ratios to figure out their monthly that they could qualify for. And then you would also be using the amortization factors in conjunction with that to figure out how much loan they can qualify for. So this isn't the exact style of question, but this is kind of similar to what I'm talking about. And it's hands down the worst kind of math out there. It's so bad. So bad that if I had to give you some advice on it, if you ever see one of those on the test, take the L. I mean, I swear to God, take the L. Because it's still just 1 point, right? One question. And the amount of time and the likelihood of you getting the question right, not to be offensive here, but it's just a very hard math concept. I even have to rack my brain how to teach it every single time that it comes up. And that's why I told you I took it off my test, because it was a very difficult question, but it still arguably could be on the state licensing exam. What you got, Sinful?
What do you mean? Can you go back to that question, the previous question?
Mm-hmm.
So, what is the reason actually the minimum 28% rule? Why you avoided the buyer car payment and the monthly debt? Is there any particular reason, or?
You're asking why we don't deal with the car payment and the 28% rule?
Yes.
Yeah, because that's how they're designed. I told you the 28% rule is stating that your total housing expense, just housing expense, cannot exceed 28% of your gross monthly income. That's what it's designed to do. And the 36% rule is stating that your total recurring obligations, including housing expense, cannot exceed 36% of your gross monthly income. It is by design that one of them's only looking at housing expense and the other one's looking at total recurring obligations.
Okay, I got it.
Yeah.
Thanks.
Mm-hmm. So there are other ones that you can practice in here for different types of financing math. And as I said, if I'm feeling froggy and we have plenty of time, I'll show you the really horrible, horrible questions that I'm talking about. I think there might be one on the practice final, but it is just a practice final, so you may see it. And I told you too, the 28 and 36% ratios are really going to be the only ones testable. And even then, I don't think it asks you to memorize them. More often than not, the test question will say utilizing the 28 and 36% ratios. They typically say that on a test question. And you're really not going to need to remember the 31 and the 43% for FHA. They don't ask you to do the math on that one. It's just more of like, just in case you need to know that it's different. And as I said, VA loans just look at one ratio. It's 43% across the board. Total recurring debts cannot exceed, including housing expense, 43% of your gross monthly income. Beverly says, are there any other housing expenses that could be used besides HOA in the equation? No. They don't include things, folks. Basically, the way that the banks look at it is they only care about these expenses if you're going to go to jail or it's going to affect your credit report if you don't pay them. So they don't even look at things like electric bills, cell phone bills, gym payments. None of that's considered because you could arguably stop paying it and you're not going to jail. You're just going to be cold, you're going to be fat, and you're going to be something else. You know, you're not going to jail if you stop paying it. Okay, so it's just they don't care. It's child support, alimony, car payments, credit card payments. All these things count because you're going to be in big old trouble. But for housing expenses, they don't look at things like electric or insurance insurance escrows are part of that, obviously, in the pity payment. But yeah, good question. Let me ask you a question here, folks, as I like to do. True or false, the FHA will loan you money to purchase a home providing you can meet the minimum 3.5% down payment to meet their standards. Yet again, this question typically gets some people. I don't know if y'all are just really intently looking at the slides, if y'all are just actually learning stuff, if y'all are just reading. I don't know, but I'm not tricking you with the ones that normally trick people. Folks, this is false, and it's false for two reasons. Number one, the Federal Housing Administration does not loan the money. They just insure the loans that the banks lend you. Number two, only having the 3.5% down payment is not enough. You would also have to meet the debt to income ratios and adequate credit scores and adequate, job stability and all the other underwriting guidelines. So, didn't trick you on that one. How about this one? Which of these would be an allowable advertisement based on Regulation Z? There you go. Two only, because while it is a specific number, it has nothing to do with loan cost. It is that the seller is willing to pay some of your closing costs. That is not a loan term. Monthly payments as low as $800, that's a specific number. That's a trigger term. $3,000 down payment, that's a specific number. That's a trigger term. But two is okay. Folks, yay for you. Financing's done. Whoop, whoop. Now, that being said, definitely consider going back and listening to the financing video again, because there is so much to it. And so it's not one that I recommend that, even though we can technically get through the meat and potatoes of it that fast, that's a set it and forget it kind of thing. You should revisit it for sure. Just to quickly go over the couple big pieces of vocab here. Blanket mortgage, remember, would finance two separate parcels of real estate with one loan. PMI, private mortgage insurance, that's for conventional loans when you put less than a 20% down payment. If it was a FHA loan, it's just called mortgage insurance. It's not private. Installment land contract, also called the land contract, also called the contract for deed. Big piece there. Seller retains legal title while the buyer is making installment payments and holds equitable title. And only once the final payment has been made will the seller transfer legal title to the buyer. Not to be confused with the one across from it, which is the purchase money mortgage, where the seller is the bank. They will transfer legal title at closing to the buyer and take back a note and a lien against the property, just like the bank. Big difference. Buyer gets legal title at the time of closing, even though they're making payments still. LTV is your loan to value ratios. Of course, the percentage that you are borrowing based on the purchase price or the appraised value, whichever is lower. Regulation Z, also called TILA. By the way, RESPA has a nickname too. It's called Regulation X. If you see Regulation X on the test, that's RESPA. We'll get into that in the next section too, which is closing a real estate transaction. I told you we're going to talk about RESPA and TILA a little bit more in that section. course, the closing disclosure is required to be given to you, part of the TRID rule, RESPA, within 3 business days prior to settlement. And of course, ARM stands for adjustable rate mortgage. Whoop, whoop.